All right. Good evening, everybody. Let me know if you can hear me clearly in the comments, please, and just make sure that this visual is also okay. Bear me 1 second. What's going on here? Are we going through this? Okay, yeah, I think there we go. All right, guys, welcome. This is obviously midweek, so this is a Wednesday. Normally do these on a Sunday, but I thought let's do it anyway midweek because obviously there's lots of stuff going on in the markets right now. And in addition to just, I guess, talking about some of the investment principles that I think are important for people to remember right now, I just wanted to kind of also make myself available to answer some questions of the sort. And I'm sure many people will have questions. So let's get through them as we do. But before we actually start, one thing I do want to kind of just elaborate on, and I did kind of mention this in yesterday's video, but you know, if I was going to cover everything that I wanted to talk about, because there's so much to talk about, and the video will be like an hour long. So I think we have to be mindful of the noise and the hysteria around, you know, China and a market crash. And, you know, it's been a turbulent week or so, even in crypto. Crypto has taken a bit of a dive as well. And it is natural for people to kind of sit there and think, okay, I'm a little bit worried. And I didn't mention it in yesterday's video, but one of the providers that we talk about a lot here on YouTube, well, I've done little bits on them. I haven't done anything major on them, but a lot of other influencers do talk about them quite a bit. They did a research or a survey piece, which I spoke about on the podcast this week. And some of the data that's out there, I'm going to do a separate video on it. But what I thought I'd wanted to do is actually have the provider also have this conversation with me, because I think it is a two-way conversation. They are a provider. People are using them to invest in the stock market. And some of the data points in the survey were actually really, really worrying for me. One of them was the fact that, you know, there are a lot of people who started investing that they surveyed, and I think they surveyed about 3,000 people or so. A lot of them are first-time investors, not really having any experience. I think the numbers for that were around about 58, 59%. And the most disturbing thing was that out of those people who were new investors, when they asked what they held within their portfolio, 96, almost 97% of them had purely got individual stocks in their portfolio. Now that's a little worrying for me, purely because of the investment principles that we're going to talk about in a moment. Holding individual stocks in a time like this means that you're going to be invested potentially, the market takes a dive, and then all of a sudden you're going to have issues with how your portfolio is actually built and the risk that you carry within that portfolio as well. So it's really important to understand some of the really basic investment principles before diving into this kind of stuff. But unfortunately, people are already there. The other thing that really kind of worried me as well when we had a look at this was they part of the survey mentioned, I think it was about 46 or 47% of the people who were surveyed said that they didn't actually have any investment goals. They were just doing it for fun. And again, I talk a lot about, you know, goals. I've spoken about that, you know, throughout this year on this channel and on the podcast. And goals are important because when you enter into phases in the market like this, where, you know, there is a little bit of turbulence, there is a little bit of volatility, things are very, very tricky right now. If you haven't got a goal, it's very, very easy for you to then panic and say, well, actually, you know what? I'm going to basically close down my entire investment proposition, cash in at a loss. And you should never, ever do that. The fundamentals and the foundations that you need are absolutely crucial. They're really, really important. So I want to spend some time just talking about that. Now, if I have to reel off the investment principles, a lot of you will remember a lot of these because I've covered them across numerous videos. But I thought, let's do this in one place so that anybody who's watching this can kind of really get everything in one package, right? So the first thing that I think is a really important principle for everyone to bear in mind, particularly with market volatility and all of the noise around the market right now, is that investing is not a short-term game, okay? If you're talking about short term, then really you want to be looking at trading. And trading and investing are two very different things. People use them interchangeably, but they're not the same thing. They are very, 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 very different. Now, if you're in it for the short term, there is nothing wrong with you looking at trading options and looking at maybe trading Forex stocks. You can trade so much stuff, but it is not investing. Trading is a different skill set. You need to have a different set of skills for it, period. You need to understand technical analysis. You need to understand all of the stop losses and the science and all that stuff around that. So that's short term. Investing, what we're talking about, what I talk about on this channel, is more about the long term. Now, when we talk about long term, what do the terms actually mean? Really, in the investment world, you should not be investing if you are not going to be looking at investing for at least 5 years. You might be able to scrape to 3 years at a push. So you might be able to get away with it at 3 years. But as I explained in my investment course, and I'm thinking whether I should just make this available to people, because this is really, really important. You know, if you are investing for 3 years, you carry a lot of risk. If you look at the market crash back in 2007, 2008, it took about 5 to 6 years for it to recover. Typically, historically, those cycles take longer to get by. So in instances before that, you're looking at maybe 9, 10 years for the markets to recover. Some people are arguing and will say that the market recovery cycle has retracted down to that 5-year period. But if you're investing for 3 years, and for example, you see the market crash in the first or second year, you won't have enough time for the market to recover in order for you to get back to a position where you're going to be, you know, able to basically take your investments. You are likely going to be in that position looking at cash in and a loss. So it is about long-termism. It is about thinking long-term. 5 years really should be the minimum term that you look at if you're looking to invest in the market. That leads me on very nicely to risk and understanding risk. Obviously, whenever you invest in a company, it is a risk. You are taking a gamble. The idea with this is that you are looking at the company and you are saying, this is particularly true if you're investing in individual stocks, you are taking a bet. You're assuming that the value of this company is going to be higher than it is right now in 5 years' time, 6 years' time, 7 years' time, whatever your investment term is. So this is why we talk about goals. When we talk about goals, what are you investing for? Are you investing for a house deposit? Are you investing for retirement? Are you investing for school fees? Are you investing to have a nest egg, so a pot of money that you're going to be able to access at some point in the future? If that is the case, all of those scenarios should be time bound. So if it's for university fees and you've just had your child, then that means you got an 18-year investment term. If your child is 12 years old, going to university at the age of 18, then you've got 6 years as your investment term. Everything should be time bound. With that being said, and with the notion of time being really, really important, again, market cycles, recoveries, the next thing you need to be having a look at is, what risk are you willing and able to take? Okay, what risk you are willing and able to take. Those two things are not the same thing. And let me explain why. When I was advising as a financial advisor, and even in the work that I do now, when I coach people, people will often say, I'm adventurous with my outlook to investing. And one of the things that I do when I coach is I actually go through a scientific questionnaire, which is a risk questionnaire with people, to really understand, based on scientific questions, where you come out on your risk profile. Now, guess what? A lot of people who assume that they are adventurous are not adventurous. When I was advising and as I coach now, the most popular risk profile for 99% of people is balanced. That is, if you were to score out of 7, and I'm going to use 7 because most of the investment houses use 7 on their documentation when you're looking at the key facts about a fund or an investment option. If you're a 7, then a balance will mean that you're about a 3 or maybe a 4. Now, time does interact quite tightly with the level of risk that you are able to take. So, for example, if you are investing for a 5-year period and you are balanced, there is no reason why you should be investing in a really adventurous fund. And I'm going to use Vanguard as an example here because we talk a lot about Vanguard. There is no way you should be picking the Life Strategy 100% fund. No way. If you are balanced, then you should be in the 60-40, 40-60 roughly fund. That is the one that's made for you. And I'm talking about the life strategy fund specifically because they are risk rated funds. They are built with risk in mind. So again, if you're investing for 5 years and you are balanced, there is no way you should be investing in a 100% equity fund with a lot of high risk. We'll talk a little bit about index funds and ETFs a little bit later on. So that's someone who is investing for 5 years, who is balanced. Now, let's extrapolate that out and move the timeline out a little bit more. So let's just say you're investing for university fees and you've just had your child and you've got an investment term of 16 to 18 years. If you come out as balanced, the argument is because you have an investment term of 16 to 18 years, you can afford to wait out any market crashes if they were to happen. So talking about the last market crash happened in 2007, 2008, it took 5 years to recover. If you've got a 16 to 18 year time horizon, it doesn't matter if the market crashes in the first year, second year, fifth year, even the 10th year, you potentially have enough time to recover what you've had. Now, importantly, when you're looking at investing, it's not just about investing and just, finger in the air, we'll see what happens. Investments need to be reviewed on a yearly basis. And this is the whole point of having goals in the first place. You should have a clear idea of why you're investing, what you're investing in, how long you're investing in the markets for, and that should dictate what you invest in. So ETFs, which ETF, index fund, which index fund, the composition of the index fund. Your goal should pretty much dictate all of that. Now, if you are investing for the long term, there is an argument in investment theory to say, because you have a 16 to 18 year term, even if you come out as adventurous, so again, using the 7 scale within Vanguard, you might be a 3. The argument is because you've got such a long time and you have the time to wait out any market crashes, any market cycles, you could potentially push yourself up from a 3, maybe to a 4, maximum to a 5. Never a 6, never a 7. You're not looking to take huge leaps and bounds in terms of the risk profile or the risk that you're taking when you're investing. So if we're using the life strategy funds as an example, if you are a balanced investor, which you will probably be the 60-40, so 60% equity, 40% in bonds, you could probably go up to the next one up. But 100% equity, you'll be pushing it. And the reason for that is because of time. So that's a really important investment principle for everyone to really, really bear in mind if you are just starting out or you're intermediate, you're just trying to get comfortable with what's going on and how investments work. This is fundamental, guys. If you miss this stuff, you're the one to blame, nobody else. Because there's lots of content here on YouTube and it is about being discerning enough to pick the right videos and the right content to watch. And I know that it is difficult because there is so much noise and FUD out there at the moment. There's so many people talking about active management. They buy this stock today. If the market crashes tomorrow, and whilst they say, this is not financial advice or anything, if that's the only content you've been watching and you've not bothered to worry about your timeline, how much risk you're willing to take and able to take, and I need to give you the distinction between that, and you've not fully diversified. In the video yesterday, I spoke about diversification. Diversification is everything when you invest. Diversification can be the difference between you making money and losing money, because the idea of diversification is you are not putting all of your eggs in one basket. I'm going to say that again. It's not putting all of your eggs in one basket. So in other words, what you're trying to do is you are trying to assess the global market, the global economy, and you're trying to get exposure to the best markets out there. The biggest at this point in time is the United States. That is the reason why when you look at Vanguard or any fund manager, if you look at their global fund, where have they got most of their money? In the United States, because it is the largest market. When you then have a look at global funds, equity funds like ETFs or index funds, you're also then going to see a very quick follow-up with other territories around the world, which will be Europe, will be UK, it will be Asia Pacific, it will be emerging markets, which will include places like China. Global diversification is everything. How the portfolio is built and where the money is allocated to is where you make or lose money. That is the real sexy stuff. And I'm sorry that it's not, buy this stock, it could go up, 200% today, or, you can make thousands of pounds overnight. This is not what investing is all about. If you've been following that stuff here on YouTube or anywhere on social media, then I would strongly suggest that you need to source other forms of information, because if the market does correct, like everybody says that it is, and it's way overdue, and there's lots of people making video on this right now, yes, it should be something you should be concerned about, but it is something you should definitely be concerned about if you are not paying attention to everything that I'm saying or have said in this video. If you've simply followed the hype of individual stocks, you are going to get burnt potentially, and you are going to have to wait it out, because if you don't, you could potentially lose everything that you invest into the markets. All of these fundamental principles are so crucial. Now, I did skip it. Let's go back to it. The risk that you're willing to take and able to take. And the reason why the two things are different is because, like I said, most people feel as though they're adventurous when they're not. Most people are balanced. That's the risk that you are willing to take. So that's saying, right, I have £5,000. I am willing to take X amount of risk or put it into this fund with the view that the fund will grow over the period of time that I'm investing for, and that will give me my investment returns. That's the risk that you're willing to take. The risk that you're able to take is what we call in industry capacity for loss. Okay, so capacity for loss is asking yourself the question, this is £5,000. I've worked really hard for it. If the market were to tank 50% tomorrow, how am I going to feel about it? Is it going to completely ruin my financial landscape in terms of that's all the money I've got, I cannot afford to lose £2,500 overnight? If the answer to that is no, Pete, I definitely don't want that to happen, then guess what? You are not adventurous, you are more balanced. If you're balanced on the risk questionnaire, if we were to do coaching and I asked you that question and you said, no, I cannot afford to lose £2,500 if the market crashed tomorrow, I will be telling you that actually you need to be more on the cautious spectrum. Now, this is the big mistake most people are leading with today, and I'm going to talk about this, and it's not going to be popular, but I really don't give a shit, because people need to know this, because this video will be on YouTube for prosperity. And people can always come back and watch this and know that someone said it here online. If you are investing purely with the view that you're chasing as much return as possible, you are starting with the wrong foot, and you're on your way to potentially getting really hurt. The markets are the markets. We do not control what returns you get. It is impossible to do that. Now, in coaching, what I typically say with people to people is this. When you invest, you have an idea of what you're investing for. So I'm going to use the example of school fees. So if you work out and say, right, school fees for my child are going to be X amount per year. Let's just call it, I don't know, £4,000 per year. I'm just calling out arbitrary numbers here. And the child's going to be in school for 6 years. Then you need £24,000. Now, when you're investing, one of the things that I do in coaching is we try to work backwards to say, right, if you need £24,000 over that period of time, how much money do you need to put in now? And we do a lot of work around assumptions. And with investments, assumptions are a double-edged sword, because they can be good and they can be really bad. Historic performance is no indication to future performance. However, if you have a goal, the assumptions can help you to start to build train tracks. So you at least understand and know, right, am I on the right track in terms of what I should be expecting or aiming for? Now, you don't get to control whether the market does 8, 10, 9%, 15% per year. You don't. A lot of the time, if you're investing in index funds and ETFs, your provider selection becomes gold for that circumstance. So, for example, Vanguard, BlackRock, Fidelity. What you can do, and this is the great thing that we used to do when we were advising, is we would have a look at what the funds have done in the past. And in particular, we would zero in on what did the fund actually do in the instance of a market crash. So back in 2007, 2008, did the fund tank by 50% if the market dropped by 50%? If they did, then you could argue to say, well, actually, maybe the management of that fund isn't that great. Maybe they missed the trick, and you would question whether you would use such a provider. However, if you know that the market tanked 50%, but the fund only did minus 20, then you know that they've got mechanisms in place, management in place, that it's protected their clients from experiencing the full 50% decline. Now, unfortunately, declines in the market are real, and there's nothing that you can do about it. It comes with the territory. But looking at historic data to understand, number one, what is the provider's track record in difficult times is really important when you're trying to pick ETFs and index funds specifically. And it is no indication to what the funds will do in the future, but what it does do, it gives you the ability to assume. So let's just say over the last 5 or 10 years, this fund, even in a downturn, has returned over that period of time an average rate. Then you could assume and say, okay, well, if it repeats itself and does something like that, say 5 or 6%, 7%, you look at Vanguard, over the last 5 years, a lot of the funds have done, between 10 and maybe 15%. You can start to assume those numbers. Whether you take the full 10%, 15% is down to you. You might want to be a little bit cautious and say, actually, let's take 8% of that. Put yourself in a safe zone. The reason why that's important when you're trying to work towards things like school fees is because you've got such a long investment time horizon or time that you're investing over. You can give yourself little targets to aim for. If the fund doesn't do 8% per year because you're reviewing this every single year and it hasn't done the 8%, then the question will be, right, why is it? Is it because another pandemic's happened and the world shut down again that the fund hasn't performed? You want to be asking those minute questions. And this is really, really important in selection. This is even more important if you are picking individual stocks. And if you're picking individual stocks, people talk about research. Research is so, so important. You have to try and understand how a company might be impacted if the economy were to crash. You will never really know, but you should be able to tell if you look at the financial accounts. What is their balance sheet saying? What is their earnings per share? Are they profitable? Are they paying dividends? What is their track record from a financial point of view as a business? Most businesses that come through recessions are ones that have cash. They have assets, cash on their balance sheet that they can call upon should they ever need to. If you're picking individual stocks, I have to stress it is really, 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 really important that you pay attention to that. And look, it means also that if you are picking individual stocks and you see a market downturn, you're responsible for what you do, unfortunately. And you know what? There are a lot of people on YouTube, and I'm not trying to take a dig at anyone here before people get in the comments after they've watched this, but there are a lot of people who talk about picking stocks, all this kind of stuff that really haven't worked in this industry and really are just learning on their own and learning for themselves, sharing their journey. I think is really important that you have to be able to distinguish people who are learning on the job, like on their own journey and showing you what they're doing, versus people who are saying, this is how it works. You should be asking, what is their experience? Do they have qualifications? Have they worked at this at a professional level? Because all very well managing your own investments, but the responsibility of your investments is yours. I come from a background where we are overly cautious in what we do because we used to advise on people's money. And we are custodians. We are almost guardians of what people expect and aspire for in later life. And the reason why I'm so hesitant a lot of the time to say, go and buy this stock is because number one, I never would. And number two, it's completely and utterly inappropriate if I tell you, go and buy this stock tomorrow, because it might not be right for you. There are so many moving parts. And if someone is telling you to buy stuff on YouTube and they don't understand anything about you, your goals, your time horizon, then it is plain wrong. And it is down to you to discern the kind of content that you're watching and how you actually take the content that you are watching and utilize it, and at least use it as a basis for research. And I will say this here on this video, so it's here for posterity. You don't necessarily want to just be listening to me. Yes, I'm a qualified financial advisor. I have advised people, wealthy people. I have worked for a DFM, which is a fund manager. I have worked for investment houses. I've been around for 16 years this year. It doesn't mean you should solely listen to me. Go and get other opinions, but ultimately, the opinion that you form for yourself, which informs your actions and what you do, is down to you. Because at the end of the day, for anyone who's invested over the last 18 months, if the markets do tail off, you can't point the finger at anyone that you've listened to or watched here on YouTube. That just is the plain truth. So I hope those investment kind of like fundamentals were really important. There's more that I can go into, but we just won't have enough time. I'm going to get into the comments right now and just see what questions we have in here. So bear me 1 second, guys. I need to do one thing. Bear me 1 second. I'm going to be back in literally just a minute. All right, okay, let's get into these comments, see what we've got here. Where are we? There's quite a few. Okay, quite a few here. Let's have a look. I'm going to start from the top and work my way down. What do I think of the Baillie Gifford China Growth Trust? Now, Baillie Gifford, they are not they're not novices or anything like that. One thing that you can rely upon if you are referring to an investment house or a fund manager like this is that they will be extremely well researched in what they do and how they actually pick their funds and construct things like their trusts. They will be the ones who will be going out to businesses, sitting on boards of companies to really understand how the company operates before it gets included within their investment vehicle. Like I said before, in the industry, we regard ourselves as custodians for people's money. Yes, there are occasions where you have cowboys that will take decisions that really don't make any sense. But a lot of the times with a lot of the big investment houses like Baillie Gifford, Vanguard, BlackRock, Threadneedle, Schroders, all of these guys, they will be making very, very calculated decisions based on research and based on face-to-face, press-to-flesh with people, essentially. Now, China specifically, the investment world have always been a little distrusting of China. And I mentioned it in yesterday's video very briefly, but the Chinese kind of do what they want to do. They don't submit to things like audits. That's why it was threatened at the beginning of this year that some of the Chinese stocks were going to be taken off the US stock market because they don't like being audited. They do run by their own specific rules. That has been the case for a good number of years. Investment houses, fund managers, they are aware of that. So a lot of the times, if you look at the holdings within all of these investment managers and fund managers, you will find that a lot of them, a lot of the time, won't hold certain assets because the research basically tells them that they maybe need more information. When they ask for more information, they probably don't get it. So as a whole, the industry has always been a little bit skeptical of China specifically. If you do have a Chinese growth fund, then again, it will be researched. I don't know what's actually in that growth fund to be able to comment on the actual individual holdings. Will they have exposure to Evergrande? Possibly. I don't know without having a look at it. But you can trust one thing. It will be as diversified as they saw fit at the time. Doesn't mean that they can't get it wrong. They obviously do, and they have in the past. But all the choices that they would have made would have been based on research, lots of research. And it's not just about the Chinese equity market, it will be about the property market, it will be about their bond market. These investment houses and fund managers have floors and floors of people that they pay very, very handsomely to look specifically at equity markets, bond markets, property markets, commodities. They have floors of researchers. So you can rest assured that it will be well researched. Doesn't mean that they're going to be infallible, because nobody is infallible, but they will be really, really well researched. Right, this is a question. Hope you work. Can I have a SIP? Can I have a SIPS pension and workplace pension and pay into both at the same time? Yes, you can. I would perhaps question, maybe, well, let me rephrase this. I won't question, but I will ask you to think about the logic of the workplace scheme and a SIP separately. So a SIP is something that you're going to manage. It's self-invested personal pension. You're going to self-invest it yourself. Now, a SIP is great if you've maxed out all of your contributions at work. In other words, there is no matching. So, for example, some companies will do a matching scheme. So they'll say, if you pay in 8%, we'll come at 8. There is no reason for you to do a SIP if you've got a matching program at work and you haven't fully utilized that, because essentially it's free money. If you've got a matching and you've maximized that, but you still want to continue to pay into a pension, then yes, you can go for a SIP. With SIPs, they can be expensive. Workplace pension schemes are often more cost effective than SIPs. However, you may not have the range of investment choices that you have with a SIP over a workplace pension. SIPs give you a little bit, they give you way more flexibility, actually, way more flexibility. More so than a workplace pension. But you have to have a look at them and be very pragmatic in your view in terms of, where do you think you're going to get the best bang for your buck? Depending on who's managing the workplace scheme, you may have a good number of investment vehicles available to you. If you don't know how many fund options you have available within the workplace pension scheme, then I would certainly encourage you to go find out to make sure you're in the optimal one. But yeah, look at the workplace scheme. Look at a SIP as a backup to that, but you definitely want to be making sure that you are maximizing any matching that might be available within your scheme before moving over to a SIP potentially. Let me just highlight this one very quickly because I've just seen this come in. If there is a question here, I will answer this as well. Bobo, thank you for this, by the way. Super chats really do help with the channel. I think hydrogen could become a very big thing in the future, especially as a replacement for gas and batteries. What are your thoughts on hydrogen stocks? The technology still needs to come forward. I think, the EV space has definitely got a huge jump on hydrogen at the moment. If someone could come up with a proper workable scheme, I think that you could potentially see quite a bit of room within that. I don't know. I just feel as though the EV space has moved so far ahead. I don't know how hydrogen would actually catch up. The benefits of hydrogen are actually are quite obvious though, because at the moment I drive a Tesla. I've got to park up, I've got to supercharge, and yeah, it will take me 30-40 minutes, which isn't that long, but it's still 30-40 minutes. With a hydrogen, you can literally rock up like you normally would do an internal combustion engine and literally just fill up the tank in exactly the same amount of time. So time wise, it's more efficient. The technology needs to catch up. And I think, from a science point of view, there was always this issue of, hydrogen being a little volatile, unstable. So if they can crack that and they can get that right, then I can see legs. But the EV space is so far ahead right now that they would need to have some serious investment to make up ground. And you would need to have some serious players come in with a really compelling proposition, product, to take away from the EV market. I mean, the adoption of the EV market over the last, I've had my Tesla, for 6 years, and you rarely saw them on the road. Now, they're everywhere. And it's not just Teslas. There's the VW, the ID4s, the ID3s. They are everywhere. It's absolutely huge. And a lot of the big car companies, they haven't gone hydrogen. They're all pushing to go electric. So I think they could be good, but I think you would need to see some serious players and some serious developments on the technology side as well. So thanks for that. Thank you for the super chat. Really do appreciate it. Guys, there's 47 people on this live right now. If we can get the likes up to 20, 25, that will be absolutely amazing. I'm just going to find my next question. This is a good one. Love your work. What's the best investment books to read? I've got one up here, which is How I Invest My Money. If you go to my Instagram, it's in the link tree under books. I like that book personally, purely because it's written by people who work in my industry, and it talks about how they think about investing their money and what they do to invest their money. It's very, very eye-opening. And as professionals, people who work in the industry, I'm going to give away a little bit of the book. But guess what? They're not buying individual stocks, okay? And these are people who have been in the industry for many, many years. A lot of them for many, many, many years. You'll pick up the whole concept of the thing that I talk about, goals. That runs through a number of them in the book in terms of they look at investing from the place of what they want their life to be and how investing adds value or makes that possible. It's not about the monetary figure of making a load of money. Making money is fine, but what does that money actually do for you? That is the bigger question. It's funny, I had a discovery call earlier on with someone who's actually taking my course. We're going to go into some one-on-one coaching. And he was saying, I want to earn £1 million. And I was like, okay, well, so is the £1 million income more important than £1 million in assets, which could be property, which could be investment, stocks, equities, businesses? Is the income more important than the assets? Because the income you could get, you could spend. You could invest as well, to be fair, but you could spend. Whereas with an asset, if you acquire an asset, that asset is income generating, which gives you more income. So which is more important? And that thread kind of runs through that book. And it's quite telling because you start to kind of think, to realize that actually for people who have been in the industry for a very, very long time, they really take it back down to the basics, which is why I talk about goals so much, because they are so important. It dictates everything that you do. It dictates what you should do, how you should do it, and what vehicles you should use. And if you don't know what your goal is, then what you're going to achieve at the end of the day. When I was advising people, we used to spend an inordinate amount of time talking to people about what does this money mean to you? What is it there to do? What role has it got to play in the life that you want? It's so important. And I think sometimes we lose sight of that because social media is all about this material stuff. The cars, the watches, all this fancy fugazi nonsense does not matter. The flashy stuff does not matter. I can say that now from experience because I'm 42 in November. All right. When I was in my 20s, you couldn't tell me anything. And I hope that, for people who watch my channel who are in their early 20s, 18 to 25 and coming into their 30s, I hope that you do hear it from me, because you'll finally realize that actually just because you wanted to buy that pair of Louis Vuittons, you'll realize it's a waste of money once you have it. That's what happened to me. I've got Balenciagas, all kinds of designer shoes. I don't wear them. I've still got them. A waste of money. I could have invested that money in the companies that made those things. I did a post on Instagram last week. People are getting all hyped up about the iPhone 13. Well, are you more excited to buy the iPhone 13 or more excited to buy the stock Apple, because the iPhone 13 is going to drive profits, which will drive the share price of Apple? So what do you want to own, the phone or the company? It's all about goals and priorities. And that kind of links into the whole £1 million income or the asset. So that book is really, really good. It's worthwhile watching. It's called How I Invest My Money. And I said it's in my link tree on Instagram. If you want to go and grab it, you can get it on Amazon. I think it's like £8 or something like that. Right. Someone did ask me, what do I think of Damien? Damien is a good guy. He is a really, really good guy. I've only spoken to him maybe a handful of times. He is a good guy. He does kind of know what he's talking about as well. But, look, we don't know if the market is going to crash tomorrow. The reality is we do not know that. Okay. People, when I made the video talking about don't let YouTubers panic you about the market crash, it is really, really important. And people thought, you're being facetious, Pete, and you're just, you're being a bit too over the top with it. And, you're taking that comment too seriously where someone said, oh, I watched a portion of the video and sold down my investment. Now I've got to rebuy everything back, saying it was a joke. It was tongue in cheek. Well, how do you know that? What if someone actually did? What if someone who's just starting out did watch that video and was panicking and did sell down their investments when they didn't need to? It's a long-term game. We don't know whether the market is going to crash tomorrow. We don't know whether it's going to go and crash, next week, 2 weeks time, next year. People were saying the market was going to crash last year, and we did have a bit of a dip. But guess what? The markets are up 40% since then. We do not know. The point is, if you're in this for the long term, it doesn't matter. It's like going on a 100-mile journey, and then 2 miles in, you come across a road with really, really bad tarmac with potholes, and you're like, nah, I'm going back home. Thank you very much. Like, you just take it slow, you persevere, and then you get on to the rest of the road, which is smoothly paved. You might have some bumps here and there, speed bumps, and you got to go around a couple of corners and make some, hairpin turns. That's what it's all about. That is what it's all about. If you're in it for the long term, if you're in it for the short term, then you should be worried. Frankly, you should be worried, and you should be looking at your portfolio thinking, okay, I hope I'm in the right place. But if you are investing for the short term, well, you shouldn't be investing. Anything less than 5 years, you should not be looking at the markets. The risk is way too high, especially if you're picking individual stocks, especially if you're picking individual stocks. And a lot of these YouTubers who don't work in the industry don't really understand the financial services industry. I'm not saying Damien is one of them, by the way. They're talking about, buy this stock today. Well, you got to be careful with that kind of stuff. Yes, you got to buy the dip, but you should have a plan. When you're buying something, the question is it going to be worth more than what it is worth today? Do you think that the value is going to go up over that period of time? And when you're investing, especially if you're buying individual stocks, you should have your exit plan mapped out right at the beginning and an understanding of, right, if the market does do a -10, what am I going to do? If the share price does a -10, -20, -25, what am I going to do? Am I going to cash this in, or am I going to hold, or am I going to reinvest? Really important if you're picking individual stocks. So look, market might crash tomorrow. We don't know. It might be crashing right now. This might be the tip of the iceberg. We don't know. But if you're in this for the long term, it does not matter. You don't need to panic. This is what happens. And if it does crash tomorrow, guess what I'm doing? I'm buying more, because at the end of the day, you always buy a falling market. A lot of people have been buying a rising market over the last 12 months or so. That's the reason why people are worried, because we've been buying at the top of the market where we should be buying our stocks low. My camera's going to go, the battery. So bear me 1 second, guys. I'm just going to change the battery out very quickly, and then we'll get back onto some questions as well. Where am I? Let me just put a holding screen up here. Bear me 1 second. Right, apologies, guys. My main battery on the camera that I use for streaming normally is not working, and because I've been out filming a load of stuff, I don't have actually any working battery. So you're gonna have to deal with me on this one for the time being. So right, let's have a look and see what else we have here in terms of questions. Let's get that one off. Where was I? We already answered that one. Right, where were we? All right, okay, so let's answer this one here. Let me get this one off. 1 second. I haven't, you can't see me. I've just realized this. Let's get rid of that. There we go. All right, cool. So let's answer this one. If you're an investor, if an investor were to die and had a long-term investment, can a family member take the money out? No. You have to, unless it's a joint investment, you would have to either have a will that basically expresses what wishes there are in place in order to have the estate or the investment assigned to somebody. Now, within things like investments, you can assign investments, you can assign investment bonds, those kind of things. Pensions, you can actually have things like your will, or you can have you can nominate beneficiaries within pensions. But typically, if it's in a solo name, no, you would need to have a will in place with an expression of wishes of how you want the funds to be assigned or distributed to other people in the family tree. How do you best rebalance your portfolio if your goal is eventually financial independence? I think that means. Well, look, you should be looking at your portfolio on a yearly basis, Kirsten, and just to see whether you are overexposed. I mean, the beauty is that if you're going to be using index funds, so on and so forth, depending on what you actually have picked, it's all going to be about what you have and how you've got it invested. So obviously, I talk about this in my course. There are different asset classes, okay? So equity is one of them, property is another, bonds one. Then you've got things like commodities. You've got oil, you've got gold, you've got coffee, you've got iron. Those are all commodities. Then you've got things like cash and everything like that as well. Ideally, with an investment proposition, you want diversification across your equity holdings. You want bonds within there. You also may want to have some property. In this instance, for investing, it won't be residential property, it will be commercial property specifically, right? But you're going to have property in there, and then you may decide that you want to have a portfolio with a little bit of a stable with maybe something like gold or platinum or palladium or something like that, a commodity that gives you the ability to have diversification. And what you're doing when you're reviewing on a yearly basis is you should be looking at those positions, because if one asset class grows quite a bit, then what you might find is that if you had, say, a 40% equity exposure, because you've got growth on top of it, it pushes it out to maybe 45% in equities, for example. These are just arbitrary numbers I'm throwing around. What you then do on a rebalancing is you then say, well, actually, I've got 9% worth of growth there. Do you then either trim your equities back and reinvest elsewhere, hold some into cash maybe? So if you have a bit of a dip or a correction, you can utilize that cash to buy back in. There are different ways that you do it, but your rebalancing should be informed by whatever your goals are, really, more than anything else. What is your opinion on copy trade on eToro? Really good question. You know what? I actually copied someone. I think it's gone over about 2 months now, and I put £1,000 in just to kind of have it as an experiment for the channel, so that when I get questions like this, I can say these are the pros and cons. I need to do a video to review it. I meant to do one last week and I didn't in the end because other things came up. And then again, this week, same thing. I've got content already planned for this. Copy trading on eToro it's a good way to get started. However, you are depending on the skills of somebody else. So I'm copy trading someone at the moment. I've got £1,000 in there. I went through the video where I talked about how I selected him and some of the research that I'd done, right? But the reality is, for me, I'm not in control. If I am going to buy individual stocks and hold a portfolio like that, I would rather go and pick it myself, because at least I know what to look for, so on and so forth. If you don't, It's okay to copy someone else, but you need to do your research. And the investment principles that I started talking about at the beginning of this, they still apply. You need to find someone who aligns with that, your term, the level of risk that they're taking, the kind of companies they're looking to invest in. All those things are really important. Just don't go and pick someone with the highest performance in the last 12 months. That's the worst thing you could do if you're looking to pick someone to copy. You really do need to have a look at their track record, maybe over a 2-3 year period, to see, what have they performed like? What decisions have they made? What is their portfolio actually made up of? You can find all this stuff out on eToro. And for goodness sake, please read their profile, because their profile is really, really telling in terms of how they invest, what their outlook is. You want to make sure that that person thinks the same as you, and it isn't someone who is taking the contrary view to you and doing the exact opposite of what you would want them to do. So it is a good vehicle. It does have its risks. I will do an update video because, to be honest, he's done okay, but at the minute it's in the red. It was up last week. It's in the red now. And it's been in the red more than it has been in profit. But those are the kind of things that I'm going to explain when I do the update video. But just be careful if you look into copy trade someone on eToro. So what are the best stock investments in the UK? Individual stocks, I can't tell you because, again, it's all about what your goal is. Look, if you're looking to invest in the UK, all you need to basically do is go onto Vanguard or go onto like Fidelity or someone like that, and just look at what they've got in the UK portion or European portion of their investment tree or their investment offerings, and just go and have a look at the performance, how much it costs, what they're actually invested in. Try to take a look at what top 10 companies these big hedge funds or fund managers are invested in. If you're looking at individual stocks specifically, I would probably hazard a guess and say if they're invested in, all of them, across the board, invest in broadly the same companies, and you've got the same 10 companies in the top 10, then I would argue that those companies are probably good picks for anyone to invest in, because they would be extremely well researched, and they will be companies that they would have sat with the board members, and they probably have a seat on the board, and they've done a lot of research to justify them being in their top 10 of portfolios. But, I'm not going to give you any individual stocks specifically for the UK. I have done a couple of videos of examples of companies to kind of pick, with the view of diversifying your portfolio and with the view of, trying to make sure that you've got strong foundations. There is a video like that on the channel. I think, I can't remember what it's called. I'll see if I can find it here. Let me see if I can find it and I can give you the title of it. Let me go onto my studio. Content. When did I do this? Let's go to page 2. Great UK stock. So I did this on May 14th, essentially. So UK stocks to invest in 21, but the thumbnail says great UK stocks, and it gives you ideas of companies to look at. So hopefully that's helpful as well. Right, let me just get back to the streaming. Right, where was I? Just trying to find where I am. Bear me 1 second, guys. All right, this question from Gavin. Are you confident about individual stocks / businesses and know the intrinsic value? Is it better not to diversify to get a better result in compounding, especially reinvesting the dividends too? If you're willing to take that risk, then absolutely. Like I said, if you have a very specific investment strategy or outlook in terms of how you want to invest, and you are 100% confident, well, as confident as you can be about the individual companies or businesses that you've picked, then you basically run with your thesis. Hopefully you've done your research and the numbers stack up, but you can argue that there are tons of companies that are available on the US market and the UK markets for that matter, that they've been around for years and years and years. And if you're building a portfolio, those are your foundationary companies, right? Because at the end of the day, they've been around for such a long time. They have quite a lot of customers. They've got a good balance sheet. A lot of them will be dividend aristocrats, Coca-Cola, all those kind of companies. They're solid, solid companies. If your numbers stack up and that is truly your conviction, then there's nothing wrong with just running with your strategy and sticking to your guns. Whether you should be diversifying further, I would argue that you probably should, because it's the prudent thing to do. But at the same time, people have to go with what their convictions are. If you're completely and utterly convinced, run with it. Run with it, because at the end of the day, it's your money and it's your risk that you're willing to take. And who am I to tell you that you're doing something wrong? Diversify. I've not heard of them. Probably need to have a look at them. But if Buffett and Munger are looking at them, that would probably tell you something. They've seen something in that company. I would want to basically try and find out what it is, and maybe, try and do a bit of research on whether you think they're right or wrong. I mean, just because it's Buffett and Munger, yes, they've got a lot of things right in the past, doesn't mean you should just blindly follow them, because again, it has to tie in with what your goals are. And this is the thing that frustrates me. Not so much now on Instagram. There's still some of these comments that fly around of how much dividends Warren Buffett makes in a quarter. He's getting X amount of millions paid to him in a quarter. You should be investing. If you're not, you're a loser. Well, you need capital, guys. Like, this is the thing that they don't tell you. And that lures people into a false sense of security, because at the end of the day, Warren Buffett is an experienced investor that invests on behalf of people. It's not just his money that he's investing. He's investing other people's money. And yes, he's going to be prudent with it, but because he's investing trillions, his risk profile is completely different to yours. And which is why the goals are so important. Understanding the risk that you're willing and able to take, your time horizon, how you sit on the risk spectrum, all those kind of things are so, so important. You just can't copy Warren, but just because it's Warren. He's a great investor, don't get me wrong, but what he does doesn't mean it's going to be right for you. But when he does mention a company, it is worthwhile researching and seeing if, your research stacks up, and if whether, you agree with him or not. If someone ran a business turning over 1 million per annum and it's privately owned, with the sole owner having 5 million in the bank, would you suggest they work most tax efficiently? How would you suggest they work most tax efficiently? Well, for that, mate, you need to be seeing, if that is you or that is a legitimate scenario, you need to be seeing, number one, an accountant first and foremost, and then you need to be speaking to an investment professional who can help you actually use some tax wrappers to help you ring fence that money in a tax efficient way. I can't mention just one thing off to you, because there are a multitude of things you could actually do. I mean, you could invest money corporately. The biggest question is, if you want to be able to pull that out into your personal account, that's where the trouble really, really lies. And that's where you really need some very, very clever tax conversations to be had. But if you've got 5 million quid in a business account, that's a nice problem to have. But you do need to speak to an accountant, and you probably do need to speak to an investment professional as well. If you need help, let me know. I know a lot of people still within the industry. Point you in the right direction, but I cannot. I would be wrong for me to tell you, go and have a look at this, because it might not be wrong for you. I don't know your full circumstances at this point in time to be able to even begin to speculate what any one of a ton of options might be the right thing for you. Do you have to use multiple stock investment app sites, or just one? Is Vanguard best in the UK? Good question. It's really down to your preference, mate. At the end of the day, I mean, I use many. I use tons, because obviously I review apps. So what I try to do is I use the apps before I do a review video, typically, especially if it's a paid partnership. I really do make sure that I'm using it and playing around on the site and stuff. I mean, some of the collabs that I've done this year, they've been 6-7 months in the making. So you can use one, but it really depends on how you want to invest. So let's talk about that, because that's a key factor. So if you're looking to invest in individual stocks, so buying Tesla, Amazon, holding it on your own by yourself, then obviously you can't use Vanguard. So the front runners for that, Trading 212, but they're not opening accounts, Free Trade, Stake, Orca. Who else? Trading 212, Free Trade, Stake, Orca. Those are probably four that I can reel off the top of my head right now. If you want individual stocks specifically, eToro you can lump into that as well. To be fair, you could also probably lump in Fineco Bank, who I've also reviewed, because they have a very big suite of stuff you can access there. If you're looking to invest in index funds, this is the stuff that we're talking about, that I've been talking about on this live, where you're looking to invest in a collection of companies, in opposed to buying them individually and have your money spread across those collection of companies, then the likes of Vanguard is probably the cheapest you're going to find. Vanguard, you've got Hargreaves Lansdown, but they do charge you if you hold individual stocks, and they may have some additional charges for index funds as well. You can use Invest Engine. Invest Engine are fantastic. They're really good just in terms of the options they have. They're exclusively on ETFs. They did add some new ETFs into their availability list literally last week. I posted about it on Instagram last week. You can use them, but on the DIY side, if you're doing it yourself, there are no fees. You just got to contend with the spreads and the ETF cost. That's it. Who else could you use? eToro you can obviously use for ETFs and stuff like that. You can access some of the ARK investments with them, which is great with eToro, where ARK and some of Kathy Wood's ETFs are actually hard to access otherwise. There are tons others. There's Interactive Investor. I haven't reviewed them, but there's a ton. You don't have to use one. It really depends on how you want to invest, and then you do your research around who you think is best for you based on experience, the length of time they've been there, the fees for their products, so on and so forth. But Vanguard is very good. They're one of the largest. They've been around since 1975. I think they manage something like $9 trillion for people. It's crazy. So for me, I quite like Vanguard. Hi, Pete. I'm a professional athlete, and I'm finally in a position where I no longer need to be a full-time college lecturer, and I will be pursuing my career full-time. Mate, congratulations, man. It's hard to make it into in athletics and everything like that. It really is. I used to have a friend who was an amazing sprinter. He did really well regionally and stuff. And yeah, it's the perseverance that you have to have. It's like hats off to anybody who's able to do that. But yeah, well done, mate. Congrats. There's your follow-up question here. How am I best being tax efficient? Could set up a limited company as an athlete. Thank you. Right. Okay. So it really depends on what your expected turnover is going to be. Limited companies does have a benefit in terms of, you're able to take dividends. The dividend allowance isn't that great anymore, but you can take dividends if you wanted to. That will reduce your tax that you pay. You're going to be paying corporation tax, but you can put a load of expenses through the business. Things like pension contributions are a business expense, so that can help you reduce your corporation tax. It could be really good as a limited company, more so than a sole trader, because you're going to be subject to the normal £12,500, then everything above that 20%. Then once you reach the £50,000 limit, you're going to be paying pretty much 40% upwards. A limited company will help you structure things a little bit better if you have a really good accountant as well. So limited company could be really good, mate. Hi, I'm self-employed. I have no pensions. And I've just signed up for free trade. I'm looking at long-term 10 years. I've just bought a Vanguard All World. Would you say this is best? Right. So the Vanguard VWRL, really good fund. Performance historically has been very good as well. Very low cost point in terms of the fees and how much it's going to cost you to actually own and run. The great thing about that is it is globally diversified. So you're going to get America, you're going to get UK, you're going to get Europe, Canada, Asia Pacific. You'll get a little bit of emerging markets in there as well. So that fund has done very well in terms of performance. So it's probably one of the good ones, one of the better ones that you could have picked, mate. Really good. AMC speculation, play with 50% on my portfolio. If it fails, I can recover cash as I'm young. If it goes boom, my portfolio has a head start. What's your view on this strategy? High risk, mate. If you're putting all your money into AMC, that is, for me, just, mate, you need to diversify. You don't put all of your eggs in one basket. You just don't. The reality is, mate, there are plenty of companies out there, and like, don't get me wrong. We've had past spikes in the share price of AMC and GME as another one, right? That doesn't mean we're going to continue to see these spikes. And there are a lot of companies that have literally just bumbled around the same levels over a 10-year period and grown very, 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 very incrementally. Very, very incrementally. What you really need to be looking at is you need to be looking at the fundamentals of that business. And unfortunately, because of COVID, the cinema movie industry is still struggling. It's not in full flow right now. And you need to be thinking about the fundamentals. The fundamentals are really, really important. If you've just gone speculating because AMC, GME, and all that speculation out in the past, it's a really, really poor strategy. You need to understand the business. You need to understand what their forecasts are, how they're going to be making money, how they're going to recover out of this recessionary period that, or well, certainly in that sector that we've seen because of movie studios being shut down, releases being put back. I mean, James Bond is only just coming out, what, in a couple of weeks, should have been out last year. You know, big motion pictures where a lot of them will get a lot of money through footfall, and they don't really make money from, you know, tickets. They're making money from concessions, really. So if they're not getting the footfall, how are they making profit? If they're not getting footfall, mate, they're making no money at all, which means that they have to have a strong balance sheet. So fundamentals are really important, and I hope that you've looked at them. But, you know, don't put all your eggs in one basket, mate. If anything, if you're really interested in that sector, you're passionate about it, you have a particular interest in it, I'd be looking at other cinema outlets as well, maybe Cineworld, other companies, just to see, because within that pool of companies, one of them is going to perform better than the rest of them long term, in the short and long term. So diversifying in that sector may be a good idea as well. There's some book recommendations in here as well. Rich Dad Poor Dad is really, really good. Yeah. And there's a good shout out here around the whole compound interest calculator. They're very, very powerful, just for you to kind of get an idea of, you know, what might the investment look like. It helps you plan it, helps you map out your strategy. So yeah. Yes, it would. So this is where we can talk about this all day. And I did a video at the beginning of the year where people were like, oh, you have no idea what you're talking about. Okay. In a downward market, an index fund may not necessarily be the best place for you to be. But that's not a problem if you're investing long term. If you're investing over the short term, so I'm talking 5 to 10 years, short to medium term, 5 to 10 years, then you may want to have a look at active investing. But guess what, guys? Guess what? Nobody really talks about actively managed funds here on YouTube because what? They're expensive and everyone's kicking about and pushing all these cheap stuff, which is fine. You should be looking at price point. I've said a number of times, price should not be your only selection criteria when you're looking at a provider, because in a market correction, index funds are passive investments. So essentially, market goes down, it's going to go down. Markets go up, it's going to go up. In a market correction, there is a huge argument for actively managed funds. I might have to do a video on this. I probably will, actually, to be fair, because this is a really interesting conversation. Actively managed funds are where, for example, Money Farm do this. So I've got a portion of money with Money Farm. I did a review on them earlier this year because they are one of the only investment managers here in the UK where they are actively managed. When everything was going really, really like haywire, maybe like 4 or 5 months ago, they rebalanced my portfolio because they were like, I don't like what's going on. They rebalanced and repositioned the portfolio. It's done really, really well considering everything that's happened. So in a downward market or a market correction, an active management fund or actively managed fund might be something you want to have a look at, because you have somebody, a team of people in the background essentially saying, right, let's have a look at where we are. And bearing in mind, remember, these guys are getting research data every single morning. When I worked for a DFM, the investment managers would sit down every morning because they get a packet this thick, no word of a lie. And it will cover the equity market, the property market, the bond market, commodities, the whole thing. And what it basically does, it gives them an idea of, right, these are the salient points of news that you need to be aware of. This is where we feel there are opportunities. These are stocks that we feel that you should trim in terms of weighting. So sell or hold. They get all of these recommendations down on a daily basis. In an actively managed scheme, you have a team of people who are getting that data and effectively making investment decisions based on what they're getting. The only caveat to that, which is the bit that people don't like because people are pushing cheap, 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 is, well, you have to pay a little bit extra. And I always say this when it comes to cost. Cost is only an issue in the absence of value. If you feel as though in a market correction or a market crash that you don't want to be at the mercy of an index fund, even if you are investing for the long term, you don't want to be at the mercy of an index fund just tracking the performance of a market, and you want a team of people identifying where the opportunities are because they're getting data, research every single morning, then if it's going to cost you an extra, I don't know, 0.75%, you've got to ask yourself whether the cost equals value. If it does, then you would happily pay for that service. If it doesn't, you stay where you are. But yeah, index funds will just track a market correction. Actively managed funds, there is a huge argument for that in a market correction or approaching a market correction. But again, we don't know when the market is going to correct. So overall, you should not be looking at active investments because there's news on the horizon of a market crash. Because you might switch, go to active, it doesn't crash. Then all of a sudden you're paying more fees and you're like, oh, I wish I stayed where I was. All of this stuff needs to be taken into consideration when you're at the planning phase of investing, when you're looking at your goals, when you're trying to ascertain what it is that you're wanting to achieve, what your vehicles, what your options are. You should be looking at all of this and doing a tick box exercise to basically come to the decision that is effectively going to be the long-serving vehicle to your investment success or your investment journey. I like this. Money is time. Don't want the designer crap, just the ability to do what I want and not have to work. Good man. So you said live in Hastings. I'm from there. Oh, really? Lewis? Okay. Whereabouts, mate? Small world. I wish I invested in Nando's, though. Yeah, mate, where are you from in Hastings? I was down there back end of last month. I've got a project going on at the moment that I can't really speak about. But yeah, it's mate, I grew up down there. My first 8 years were in Hastings, in Hollington, Quebec Road. I used to live on there. I lived down in Warrior Square for a bit. Yeah, man, I miss it because I love the seafront and everything like that. But yeah, man, small world. Kirsten, sorry, I'm sure I answered your question. What was your question again, mate? Let me just go back up and see. I'm sure I answered your question. I'm sure I did. Was your question not this one? I did answer this, unless you had another one. I'm just scanning. No, if that was your question, I've answered it, Kirsten. You can watch this back on playback, by the way, because this will be up. I'm conscious of time. We're coming up to about an hour and a half, but I just want to try and get through as many of these as possible. And if needed, what we will do is we'll do these lives more regularly as the market situation starts to play out and we kind of get an idea of what's going to happen. Because I think, you know, what gets views on YouTube, unfortunately, will be the stock, pick stock, buy this stock, all this kind of stuff. And I think, you know, that's all very well and good. But at the same time, you know, trying to keep your feet on the ground is very, very important as well. This is a lovely question. Yes, you can, mate. You can get started with 100 quid. If you so this is where providers like Moneybox are really, really good. And Moneybox aren't as cheap as, you know, the likes of Vanguard and some of the more established brands, but you can start investing with £1 if you wanted to. So yeah, you can 100 quid is plenty, plenty. Yeah, I mean, I'm not down that much at the minute on the guy that I did copy in eToro. So to be fair, his portfolio has held up pretty well. but I'm still down nonetheless. And I'm looking at it thinking, I did it as an experiment so that I can kind of take people on the journey. But I'm also looking at the £1,000 that I put in thinking, I really want to buy other things with it and invest in other things with it in opposed to copying him. So I might hold on for maybe another 2-3 months and give a couple of reviews, but I probably will pull it out to go. I think more maybe into crypto. I'm looking at I've got the Brave browser right now for basic attention token. I will do a video on this. It's really, really, really good. And yeah, I'm earning basic attention tokens by using the browser. So I'm looking to put a little bit of money into that because I like what it's there to do as a crypto. So I want to pretty much put some more money into crypto, really, to be fair. Hi P, I currently pay into my work-based Nest pension before tax deductions. Nest claimed the tax contribution from HMRC 25%. When I do my self-assessment, do I still claim further amounts from HMRC? Yes, if you're in the bracket where you're paying higher rate tax. So if you're paying, say, 40%, then you can do a self-assessment and claim the 15% difference. But if you're a basic rate taxpayer, you don't need to do a self-assessment because there isn't anything else extra to pay, extra to claim. Additionally, if you are a additional rate taxpayer, so you're paying 45% plus, you could do a self-assessment and claim the difference. Cheers for this, Gavin. I really do appreciate it. Thank you very much. Let's have a look at this. I just want to see very quickly where are we on the studio? We've got 36 likes right now. There are 70 people. Can we get this up to 40, 45, please? If you've not liked it already, please do smash that like button. Yeah, I know you said this. Pension contributions paid are after tax to Nest. Yeah, that's fine. So you're going to get the 25% back from the government. But yeah, you would do the self-assessment if you're over and above the basic rate tax bracket. Are you familiar with Everything Money? And if so, what do you think of their 8-pillar valuation process? I'm not familiar with them. I'm not familiar with them at all. People have different ways. If they're looking at valuing stocks, people have different philosophies of doing so. So I'm sure, I haven't looked at it. I'm sure it will probably have a lot of good stuff in there. I think you can tell whether someone is talking good sense if they're talking about the company in context to the wider way things work in the economy and the way business operates. If they're taking those kind of methodologies into their valuation process, then it's probably really, really good. What percentage of our portfolio should we allocate to index funds versus individual stocks? Really good question, Theo. Mate, listen, my approach is very, very different to a lot of people. I use a core satellite approach. So, mate, most of my money, majority of my money is in index funds and ETFs. Because regardless of what I know, and regardless of the amount of time that I spend here in the industry, I would rather have the companies with floors of people who are smarter than me, who are being paid very, very handsomely, run my money. So if I look at mine, I would probably hazard that maybe 90% of my money is in index funds. And then the rest is in, individual stocks and maybe crypto here and there. That's my allocation. That's what works for me. It may not work for you. You've got to come to your own call. So how you would do that is, thinking about what risk you're willing to take and just ask yourself the question, if your portfolio of individual stocks were to halve tomorrow, because they're going to be way more volatile than your index funds, how is that going to make you feel? If it's going to be life-changing, then you probably want to maybe move more towards the index fund side. But I can't tell you a specific percentage. I don't know your risk profile. I don't know what your goals are, how long you're looking to invest for. So it's really hard to say. Without coaching, that is. So would it be a good idea to go for a 40-year long term plan, split 50-50 between SMIT and VUSA? What is the SMIT? Is that small, medium cap? Let me know. I haven't come across that one. The VUSA, first and foremost, is the S&P 500. So you're going to have US exposure there, because I don't know what the SMIT is. I don't know where that's going to be invested. If it's going to be all in the US, then that could potentially be a problem. But with a 40-year time horizon, you probably could stomach that, to be honest, because it doesn't matter. You're probably going to see maybe 3-4 recessions or market corrections or dips during that period of time, if not more. But you've got a very, very long time to go. So you could probably swing it out. I would probably just argue whether you need to maybe diversify a little bit more as a point of note. You're on the Ridge. St. Helens Wood School. I know where you are, mate. Really, really good. Next time I'm down, I'll have to give you a shout. Mate, you traded Barcelona for Hastings, mate. Listen, I'll swap with you because I'm in Shropshire. And Barcelona is a great, great, great city. Really, really good city. I've only been a handful of times, but amazing time. Hey, Pete, not related to this great conversation, but your link to your course is missing an S at the end. I'm getting a 4 when I click it. You know what? Thank you, mate. Appreciate it, because the website's just been redone. I'll have to change it all over. Hopefully, if you go onto the website, it should be there, because I think the guy did change it from course to courses. I need to change that. Actually, I'll probably just change the URL. It's going to be easier than changing all the links. Thank you for that, mate. Appreciate it. Danger Games, how you doing? Do I know anything about Wise Alpha? No, I don't, unfortunately, so I can't really give a comment. Hi, Pete. If you buy and sell shares on ISA stocks and shares on short-term basis, is it still tax-free? Well, if you sell it, well, yes, it is still, because you're using your ISA wrapper per se. The thing is, the minute it leaves your ISA account, it then becomes taxable from that point onwards. So anything you do with it from that point onwards, once it leaves your ISA account, is going to be taxable. But if you buy and sell within the ISA wrapper, yeah, it's completely tax-free. Scottish Mortgage Investment Trust. I would need to have a look at this, because I haven't come across it. So I'd need to have a look at it, Roy, to really give a good comment. Without seeing it, I wouldn't know what the makeup of it is to be able to see whether it's actually globally invested or what it's actually invested in. So I wouldn't be able to comment, unfortunately, Roy. All right, we come to the end of this. Oh, awesome. Okay, I think there's a couple of more in here. I'm currently 100% VUSA with a 40-year horizon. Would it be better to add in all worlds or emerging markets to the mix? I invest on a consistent weekly basis. Yeah, I mean, you could. Yeah, because the VUSA really is just, it's the S&P 500, which is great. I've got money in the S&P 500. It's a really, really good sort of fund. It's cheap, it's low cost, it's great. But yeah, you've got a 40-year horizon. So why just pigeonhole yourself to just the US when you've got Europe, you've got the emerging markets, you've got other areas in the world as well, which will also do very, very well. So yeah, it could be worthwhile putting in some all world stuff just to diversify a little bit further for you. All right. Okay. That is it. I've come to the last question pretty much. Really do appreciate you guys for being here on a Wednesday evening. Like I said, we'll probably do more of these because, like I say, I'm sure that people will have more questions and stuff. You know, I'm very, very conscious that I've been very, very blunt on this live. But at the same time, I'm not going to apologize for it, because I think there is a lot of nonsense out here. There really, really is. And I'm not calling out any one group of people, any person in particular. I'm generalizing when I say that. So please don't get in the comments and start pointing fingers thinking I'm better than everybody else. I'm not. Yes, I'm qualified. I have experience in the industry, but there is a lot of noise and a lot of nonsense being pushed on YouTube and across social media, period. And, you know, the whole reason why I started doing this, and I'm 200 plus videos in, is to basically share what I've learned over 15, 16 years in the industry, and having those conversations in a really easy to understand and amicable way, in a way that isn't, you know, too stuffy and stuck up. And if my language gets colorful sometimes, That's just me, because when I get passionate about things, I get really, really passionate. And, you know, a lot of the time, especially when I'm doing videos, I have to control myself, because I watch a lot of content here on YouTube, and some of the stuff I see just enrages me so much. It really, really does. And I try not to call people out, because it's not my place to do that. But at the same time, it's almost clickbait for clickbait purposes. And it's like, where's the substance? What are we teaching people? Like, really, what are we teaching people? And anyway, I appreciate you all for being here. Thank you so much. There will be a video on Friday. We'll do another live on Sunday evening and stuff like that. But yeah, this is a midweek one. Whatever it is that you're doing through the rest of the week, make sure that you enjoy yourself. Don't get too stressed out. I will catch you on Friday's video.